Thanks for tuning in to another episode of Around the Coin. Today, our guest is Martin Froehler, the CEO of Morpher. Martin is one of the perfect people to start this business. He is a mathematician, veteran quant, and former hedge fund manager. Prior to Morpher, Martin was managing director of the quantitative research firm in Zurich and the CEO of a decentralized quantitative hedge fund in Silicon Valley. So he's had this mission for many years prior to starting Morpher. And Morpher is a company that has raised about $8.5–9 million, and they're trying to allow anyone everywhere to have free access to trade anything. Now, it's a bold ambition, but they have made incredible progress in this direction. They want to allow all markets liquid 24/7, not dependent on any centralized exchange, and allowing you to short and leverage with full liquidity. So they have a token that's out there, the MPH. We explain how the token works. We talked about his history. We talked about what crypto and decentralized trading will look like in the future, and much more. So I hope you enjoy this conversation. Here is Martin Froehler. All right. Got it. I like a casual start. That's more my style instead of some grandiose introduction. But Martin, you're running this awesome company. Morpher is how you pronounce it. This seems like a path that you have been on for your entire career, having been in Quant, starting Idea Lab in Austria or Switzerland, and then moving to the States, having started the quantitative hedge fund. You've thought a lot about trading, middlemen's decentralization of the whole game. How do you describe where we are today in terms of the landscape of trading? When you think about, maybe if we segment it to just crypto or just the stock market, do you think, or do you see the majority of trades today being done through exchanges and that's slowly changing? Or is there an explosion of crypto trading? And because I think a lot of people, myself included, get blinded to think, I talk to people like you, or I see the crypto world and think that that's mass scale. But where are we today, realistically?
In terms of crypto trading, I believe we are at the very beginning of everything. Trading and investing per se is the biggest industry in the world. There are trillions in derivative markets. It is the largest market. It generates many, many hundreds of billions in annual revenue from fees. And it is controlled entirely by middlemen today. So the trading and investing industry is in the hands of brokers, of exchanges, of hedge funds, of ETF issuing companies. And those are all middlemen who stand between a trader and their product. And I believe that the big shift that we are going to see in the next couple of years is the decentralization of this entire industry. Essentially the replacement of these middlemen with software. And that's exactly what blockchain is built for. So blockchain replaces middleman with code. And that is exactly the trend I believe that we're going to see in finance, in particular in the next couple of years.
So when you think about, if you're 20 years old and you're thinking, I love trading, maybe I'll go work for an exchange, but maybe I'll take a little bit higher of a risk and just start trading independently. Do you think, knowing what you know about the trajectory of the industry of trading, do you have any views on what young people should think about, like in terms of the trajectory of their career?
I think the most important thing is learn trading and investing. And the best way to learn trading and investing is simply trying it out, making your own experiences. That's very important. And today there are actually a lot of ways where you can try that out risk-free, or almost risk-free. You don't have to manage a portfolio that's worth tens or hundreds of $1,000s anymore. You can start. This can start with zero-fee brokers. There are many popping up in the US, but also in Europe. Or this can even start with a platform like ours, where you even get a free token to trade with, and just can learn on the markets and experiment with just a couple of dollars worth of a portfolio size that you're managing with that. So learning is certainly the most important thing, and then find out what really interests you. Some people are very much into traditional finance, into borrowing, lending, into trading bonds or trading commodity markets or things like that. That's all fine. Younger people tend to be attracted towards cryptocurrencies because it's, I guess, the newest and the most booming industry, and it's also the one that has the lowest barrier to entry. So it's rather simple to open an account at a cryptocurrency exchange and to get started with Bitcoin or Ethereum with just a couple of $100. So that's what I would recommend to young people.
Yeah.
Play around, experiment, have fun.
Yeah. Take it light and learn. I want to ask you, when you moved to the US and you started effectively, as my understanding was, it was prior to entering crypto, your vision was to build a decentralized hedge fund. Am I mincing words here? Or how do you describe what happened prior to Morpher?
Yeah, so as you've mentioned already, I've been on that trajectory or journey pretty much all my entire life, my professional career at least. I personally have started trading stocks, US stocks, in high school, and later studied mathematics in Austria, and joined the quantitative hedge fund after my graduation. So I turned my hobby into my profession. And developed quantitative trading algorithms for US equity markets, but also for commodity futures. I love doing that because it allows you as a mathematician to apply a lot of your knowledge, which is rare in our field. So most mathematicians end up doing something completely different, or only utilizing a tiny percentage of what they have learned. But in quantitative finance, you can really apply most of what you've learned on university. So I really enjoyed that. Later I moved for the same quantitative hedge fund to Switzerland, to Zürich, where we have one of the best technical schools here in Europe, ETH Zürich. And we were recruiting, and I was training novice quants in Zürich from ETH. And that was the time when I started to realize how inefficient quantitative finance as a whole industry at the end of the day still is. Because we were a relatively small shop in Zurich. We didn't have a big name. And even at our shop, we had roughly 100 applicants per one or two quants that we ended up hiring at the industry, at our company. So even if I'm the best recruiter in the world, which I'm certainly not, I have to send away at least 9 people who would make excellent quants. And they end up oftentimes in other industries, and their talent for writing algorithms, for writing quant algos, is essentially wasted if they're working at an insurance company or a bank and doing something completely different. So that's a clear inefficiency. And quantitative finance within the asset management industry is, in my opinion, still the future, because it takes emotion out of predicting the markets, and it has the most consistent and the most high-performing returns. I only want to mention Renaissance Technologies at this point, Jim Simons, who is also a mathematician, and he really revolutionized the field. So quantitative finance is the future, but we're wasting a lot of our talent. And that is essentially what prompted me to try and solve this inefficiency by founding a company. And that company was Quantix, and it is still around today. And I moved to the United States to build that company, because Silicon Valley is still one of the best, if not the best place in the world to build such a company. And that company was a decentralized quantitative hedge fund. So we provided everyone with free data and free tools to create trading algorithms. And then the best, most successful algorithms would be funded with capital from institutional investors. So as a marketplace, essentially, Quantix was intended to function in a way that quants develop, regardless of where they are in the world. They could be in Europe, they could be in the US, they could work in completely different fields. We had successful aerospace engineers, for example. We had economists. So we had a broad range. We had a university professor who was very successful. We had a broad range of backgrounds in our decentralized quant community, and the best algorithms that performed most consistently were funded with capital from institutional investors. So that was the decentralized quantitative hedge fund that I've built up in the US prior to building Morpher, which is, so to say, the next logical evolution of my journey. Because the constant question that I got when I was building my previous company from my quants was, how can I trade my own trading algorithms? And the answer was always, unfortunately, you cannot. So you develop a great trading algorithm, but you cannot trade it because we were trading commodity futures primarily, and you need a lot of capital in order to get started with these markets. So they are usually out of reach of regular retail investors. And then because of our business model, and it was the only feasible model that we could implement, we could only let institutional investors, so qualified investors, invest in the trading algorithms. And that's only a tiny minority of the general population, and certainly oftentimes not the people who develop the trading algorithms. So they could not trade themselves their own algorithms. So I learned that way that the markets are usually out of reach of regular investors, oftentimes. And that's why I've set out to found Morpher. And this is what I'm working on now since 2018.
Yeah, I appreciate the background. I want to ask you a couple of things there. Is the reason why it's out of reach because of a U.S. regulation in particular, the accredited investor line in the sand that says you can't, and the rule specifically is that you can't put money into a hedge fund to be managed, or because typical people can, non-accredited investors can't invest into the market. What is the regulation there?
Yeah, so usually alternative investments are typically reserved to accredited investors. So investing in a startup, for example, something that does not trade on a regulated stock exchange, is usually out of reach. And the same goes for a lot of investment advisors. So if you're managing a fund, a hedge fund, you usually can only accept accredited investors into that vehicle because it is considered to be riskier than just trading a regular stock on the exchanges. So regulation plays a part in it. Another important part is, though, that the markets that we were trading some of them were futures markets, and they trade on the Chicago Mercantile Exchange. And one single contract of a gold future is worth several hundreds of thousands of dollars, depending on when you look. So that means that you need a lot of initial capital in order to participate in those markets. So some of the most interesting markets like gold or oil or gasoline in these days, they are simply out of reach because the single contract size is so big on the CME that as a regular investor, you usually don't have the money to build up a balanced portfolio and invest in more than one futures contract simultaneously. So that's another reason why markets are out of reach.
Yeah.
And we must not forget, in the US and in Europe, we are privileged that we enjoy that level of market access. In many regions of the world, you can only dream of trading a Tesla stock.
Yeah, that's a good point. I didn't quite appreciate that. I always tend to look at the preventative mechanisms like regulation and think, why do we have this regulation in place? Can we get rid of it and watch the economy flourish? But in reality, your point is super important, that if we don't have access in the first place, then regulation is irrelevant. When people were building these algorithms, would investors decide to put money into the algorithms that were performing the best? I assume it would just be an open market, because just because an algorithm has performed great doesn't necessarily mean it will. So it wasn't as if like there was a fund and the money would just be pumped into the top performing algorithm, I assume.
Yeah, we started initially as a marketplace, so letting investors decide, but that also was difficult from a compliance or regulation perspective, because we had to put out a lot of disclosure materials for every individual trading algorithm that we were offering, and that was just information overflow. So at the end of the day, we then decided to bundle certain algorithms and to eventually start an investment vehicle of our own, so to say, with QuantTX. But yeah, regardless of how you look at it, Quantix was a niche product for very smart people who can write trading algorithms and very rich people who want to invest a lot of money. So the minimum investment was north of $1 million. But that's not the goal that I'm pursuing. My goal is really to open up trading and investing to everyone. I believe that everyone on the planet should have the ability, the opportunity to get access to the markets. And ideally in a decentralized way that is permissionless. So that's where the whole crypto angle comes in. That is the much bigger problem than solving for a niche industry like quantitative finance, which is a very attractive niche, to be fair, but it doesn't solve the problems of 99% of the people.
Yeah, no, I completely resonate with that. And I love the product. I got in there and it's not available to deposit or withdrawal from people in the US. Is that, I believe that's the case. Is that because of the structure of the token system, or maybe we'll use that as a segue to describe as what I understand the token system is. Tell me how this is incorrect, but you have tokens that exist. They're burned when people make predictions. Sorry, they are created when people make predictions about the market. If those predictions turn out to be true, then those tokens are now created and allocated to that person's account or wallet. If they're not true, then the tokens are burned. So there's a constant creating and burning mechanism of the tokens. Is the fact that the tokens are synthetically connected to Ethereum and created and given to people that it's not permissible in the US, or what specifically is the line in the sand that you observed that said you couldn't, build in the US?
Yeah, so you're right. We have chosen not to offer our product currently in the US. And it's not so much that we think that it's not that it's forbidden in the United States. We think that our design, our entire trading platform, our way to set this up, the counterparty-lessness of our system, so to say, should make it permissible in the US as well. But there is a lot of legal or regulatory uncertainty, unfortunately, in the United States, and that's why we purely from a business perspective, we have chosen initially in the first couple of years of the existence of our platform not to offer it in the United States yet, simply because laws and regulations are unfortunately there in their infancy or not even present. And we see this now with the Ripple trial, for example, that's now going on for quite a while, and that actually hit the company Ripple many years of being into the markets and having a live product, a live platform out there. So there's a lot of regulatory and legal uncertainty, unfortunately. So that is why we have chosen, initially at least, not to offer our platform in the US. We still have the conviction internally that what we do would also be permissible under US law, simply because we are purely a betting platform, essentially, at the end of the day. You as you've pointed out already, if you want to trade a market on Morpher, that essentially just means you purchase token from us. So the token is the Morpher token is the settlement currency that we use. You purchase token, then you allocate these token on a market that you want to bet on. So, for example, the Apple stock. If your bet is correct, if Apple goes up 10%, you get 10% more token. If your bet is incorrect, you lose 10% of your token if Apple goes 10% against you. And these tokens are simply created by the smart contract, or they are destroyed by the smart contract. So, as you've mentioned already, there is constant new issuance of a token or a constant burning of token, depending on the quality of your prediction as an individual trader. And that also means that you're not trading with someone else on the other side. So that is actually not a broker and it is not an exchange, because there is no one else on the other side. On any traditional trading venue, brokerage or whatever, you have a middleman or someone who is selling you the stock if you want to buy it. That's not the case with Morpher. So you could be the only person in the world wanting to trade a certain stock and it would still work, simply because the smart contract can issue currency or burn currency to settle your bet. So yes, we believe that this is also permissible under existing United States laws. However, we have chosen to set up shop in Europe because regulations are much more clearer and well defined here in Europe. there is an EU-wide framework that specifies which instruments qualify as securities, so as financial instruments in Europe. And we know that we are compliant with what we do here in Europe under existing laws, and that is more than we would have currently in the United States. With that being said, we're planning to go to the US, and the more decentralized we become as a platform and as a service, the less risk will it be for us to offer the services. And the last centralized component of our platform at the moment is our Oracle. So the Morpher exchange needs to know what happens in real time with stock markets, with commodity markets, so with the prices essentially of the assets that we offer for trading. And that service is called Oracle. And we have created and built our own proprietary Oracle that we use now for over 1.5 years in production. But that component is still centralized. So a regulator could come and say, hey, the data comes from you, so you are to some extent the counterparty. Once that is decentralized as well, and this is what we're working on right now, this is an unstoppable and independently executing system that lives entirely on the blockchain. And then it is as decentralized as Bitcoin or Ethereum. And at that point, we will be able to open it to the entire world. That's one thing. And the other thing is we're also currently thinking of offering markets that are clearly not securities or that don't have underlying securities as a markets in the US. And just to give you an example, this could be real estate prices in your neighborhood. That would be permissible in the US, to my knowledge as well. We would just have an index for property, real estate prices in, say, New York, in Manhattan or something like that. That's an index, and that you can trade that because there is no underlying security that would be regulated otherwise. The same goes for throwing out ideas here, the cannabis spot price or certain watches or sports shoes or whatever. So there's a lot of funny stuff that we can do.
Nice. Well, I hope soon you guys are able to completely decentralize it and allow people in the US from a selfish perspective to be able to get in there. It's interesting. So yeah, it's unfortunate. I feel that the US is dragging its feet. I would hope that they at least spend their time and come up with a reasonable policy. The worst case scenario would be that they take a long time and then come up with a terrible policy. So it's decentralized. So when it is decentralized, anyone anywhere could trade anything. Effectively, I think of the ideal trading market as you have all markets included. It's 24/7. It's not dependent on another exchange. You can short each market. You have high leverage, and there's a ton of liquidity. That's the North Star, it seems like, for you guys. When you think about so just to wrap a conceptual framework around what you've built, the token is effectively more like a betting oracle, or it's like the house when you bet, as opposed to, you're not taking on, number one, you're not actually trading the equity itself. So there's no exchange that's connected to it, like Robinhood, that then connects to some other exchange that then actually has on record a purchased percentage of Apple stock. You're really just saying, do I think it's going to go up or down? And then the house is what grants tokens. And when I think about the return, so if I said, I think the market is going to, if I made a relatively low risk bet and a ton of MPH tokens were created, then I have to beat the market, right? Because when everyone is issued tokens, just like inflation, you have to beat inflation in order to realize gains. So do you think of it more? Would you use the word betting as opposed to trading?
Yeah, technically the term betting is more descriptive. Betting without a counterparty, or betting against a smart contract, permissionless betting, so to say, that would be more descriptive. That's correct. In crypto terms, one could call us also a prediction market. So essentially, you predict the future occurrence of something, like Apple goes up. Yeah, that's your prediction, and you put some token on that. And if you're right, you receive more token. So from a crypto perspective, from a crypto lens, this would be a prediction market probably. Yes. So that's exactly where we are coming from. This would be the right phrase, I think. Yeah.
How about when you think about new segments or verticals to launch into from a product perspective? I think sports betting to me is just it's like there's a large market, but it's
Yeah.
quite people who are into sports betting are into sports betting. They're not also in large part trying to short Apple stock or do some other like they think about sports, they know all the details of the baseball and is that something you would just slowly launch where if you were to launch sports betting it would be just here's another thing you could trade, or do you think about it as productization, like we have our sports betting interface and it's completely separate, like a separate product? How do you think about launching new segments like that?
Yeah, I think actually that's our superpower, that we can offer all the markets that are already out there, but even beyond that. So we can turn markets liquid or create markets that essentially nobody else can offer, or that are nowhere else tradable. Because all we need in order to create a market is a data feed. We need a real-time pricing. It doesn't even have a need to be pricing. So we could even, for example, turn tomorrow's weather into a prediction market on the platform. It would be too trivial to predict for us to do it. So tomorrow's temperature or something like that. That's too trivial to predict. But hypothetically, we can turn anything into a market. So we can turn markets liquid that are currently out of reach of regular people. And real estate is a great example of that. And we believe that this has more potential from a product perspective for us than just recreating what other products that are already out there. But with that being said, sports betting is a huge sector, and we are also looking into this. Yeah.
Yeah. When I think of sports betting, say you have a Super Bowl game, there's odds that are set by the house. So I can put $100 US in exchange for, team A winning, or I can put $100 for team B, but the payoffs would be different based on the calculated likelihood of outcomes. Is that something that is done in a decentralized manner? How does that work on?
Yeah, so essentially, it's not done in a decentralized manner. We are a layer two to traditional spot exchanges. So we don't think of exchanges as our competitors. Actually, we depend on exchanges. So we need, in order to have a virtual Apple stock on the platform, we need a stock exchange that actually trades Apple and that determines the price of Apple, because there is no price discovery on Morpher. And the same would be true for sports betting. So we would need a ratio, a quota, or something like that, or the odds essentially, and in order to be able to offer that as a market. So it is important for us to have spot exchanges, like it is for every other derivative or layer two that also depends on a functioning spot market or an external pricing. So in our case, again, it doesn't have to be a market. It just must be a data feed that is somewhere put together and in a fair and way that's not manipulable, easily manipulable. That's essentially what we need. Yeah, and then we can turn it into a market. So we depend on exchanges, and derivatives can always be orders of magnitude bigger than the underlying spot markets.
Okay, so in the case of, say, weather, so say we said, I said I wanted to bet that tomorrow's going to be very hot. I put $100 down. The reward for that, how is that determined? Is it is it set by the house? Is it set by Morpher?
Yeah, so in the case of weather, it would be too trivial. So for example, but let's entertain the idea. So in the case of weather, you could, for example, bet on the temperature tomorrow at say noon in your region, in your zip code. Yeah. And if the forecast is 20, I don't know, in Fahrenheit, 60 degrees Fahrenheit or something like that. Yeah, making stuff up, or let's say 70. Then we would just subtract 70 from the actual temperature that we have, and then you're either above or below the forecast, and then you would get money depending on whether you have been right or not with respect to the forecast and your bets. Yeah, so that would be a way how these markets could work. But that's a very complicated example, and one that we're actually not thinking of introducing. because the one parameter for us to introduce a market is that it needs to be not trivial to predict, not easy to predict. So it needs to be mathematically close enough to a random walk process that you cannot simply go in and mint token every day, because otherwise our economy wouldn't work. So if it's trivial to win on a market, that means we would have more and more token over time, and everyone would have to beat that inflation rate in order to make a profit. And that would make the platform less attractive to everyone else who wants to do some serious betting on some hard to predict markets.
So by trivial, you mean the degree of success is high?
Yeah, the degree of success and certainty and is very high. Mm-hmm.
And so you would therefore deduce real estate and commodities markets, equities, these things are more difficult. I mean, are they more difficult? I guess it would depend on the bet, right? It would say, if I think Apple is going to be, the same price tomorrow as it is today, that's highly likely to be true. I guess what I'm trying to understand is what determines the reward for my success. So if I say Apple is going to be at $1,000 per share tomorrow, if I'm right, what determines how much I get for being correct?
Yeah, so in order to bet on Apple, you purchase Morpher token. So let's assume you purchase one token for 1 cent today. And you bet $100 worth of token on the Apple stock. So you purchase 10,000 token, you put them on Apple. Apple goes up tomorrow by, say, 3%. So you would end up with 3% more token.
Oh, okay.
In this case, 10,300 token. And then you would sell the token on a crypto exchange to realize your gain. If you really want to trade just for one day, you would have to buy and sell the token. Buy the token today, sell them tomorrow, and then realize your gain. The additional risk that you have on Morpher is, of course, that the token's price can also change. It can change either in your direction or adversely for you. So that's an additional risk. So you can think of trading on Morpher as trading a stock that's denominated in a foreign currency, like trading a stock in Europe as an American. You would also have not just the risk of the stock, but also the risk of the dollar versus the euro, for example. And that is your return at the end of the day.
Gotcha. That makes a lot of sense. It's interesting dynamic there. When you think about mathematics applied in trading, I imagine that there's a spectrum of effectiveness for people who study math and quant trading. What tends to be the areas where highly complex, like PhD level math is practical and serves an advantage from those who are just simply, doing more simple trades? Like where in the market does the rubber meet the road for the higher nerdy math guys?
I believe pretty much everywhere, and the more you work in quantitative finance, the less you want to trade discretionary. So or discretionarily on a discretionary basis, simply because that the odds are generally stacked against you, and you know how really hard it is to develop a trading system that consistently beats or outperforms the market. And you know that if you're trusting just your gut feeling, you will probably be wrong as often as you're right. But actually, risk management and money management works against you. Even if you have a winning ratio of, say, 51 to 49, you're still losing in the long run. So you really need to build a system that consistently wins, that consistently outperforms the fees and the commissions and the slippage that you pay for trading on the markets. And to get back to your question, I believe that applies for pretty much every market and every trading. So I would want to. So if I had to manage money again professionally, I would only want to do that in a quantitative manner, regardless of if I'm trading commodities or equities or cryptocurrencies. I would dare say that with commodities and with equities, it's even harder to trade non-quantitatively because the markets are very efficient, because there are many participants, and a lot of smart money is also involved in the markets who really make use of every tiny inefficiency in the markets. quantitative trading firms, for example, yeah, and that it is very hard, or through the actions of these participants, it becomes very hard to actually have an edge in these markets.
So I would imagine that when I think about the degree at which a mathematical expertise is helpful and the ability to program algorithmic trading, it would be when there's a market that has a greater volume or higher liquidity. So there's more, maybe they've been around for a longer period of time. There's more data. I mean, do you think of it as a data opportunity? Whereas if I'm investing in, say, early stage startups, it's difficult to quantify a business when they're just very young, or we don't know the potential for a completely new disruptive model. Is that something? I mean, even in crypto, there's a lot of projects that have if you were to ignore the non-quantitative parts of the project, then you're missing out on a big part of the assessment opportunity. Does that resonate as true with you? I mean, certainly as crypto becomes more proliferated, there's more data and the projects are more stable, but
yeah, absolutely. I think it is fair to say that quantitative finance requires data. So data is the oil on which the industry of quantitative finance runs and operates. So the more data, the better the resolution of the data is. The more data, the more markets I have available, the more robust of a model I can build with it. And crypto is probably at this stage still comparable to early stage startups, to be fair. But early stage startups where valuation is tricky, but they can be traded in real time. So you can think of that like before the dot-com bubble, that you're able to invest into any internet company, more or less. Yeah, and that would be the equivalent of the crypto space today. There are a lot of ideas out there. Some will make it, some will make it really big. Many will fail. But you get a pricing of how well they do in real time, and that is the exciting opportunity today.
Yeah, I appreciate that. When people get into quantitative trading, so say somebody had been studying for maybe 2-3 years and they're doing this seriously, what are the techniques or the tactical approaches when you think about quantitative or mathematical trading? Is it, I mean, maybe you can enlighten me because I'm really not familiar, but I would imagine that you could analyze past data, you could make trajectory and algorithmic determinations based on mathematical trajectories of where the dots and lines are going. Are there other mental models or mathematical models that you could teach me? I mean, just give me an overview of like, what would be like like you show up to class day one, quant trading, and these are like the basic things that a person should know.
Yeah, essentially, quant trading is the attempt to find an anomaly in the data that is consistent over time, and consistent also to a certain extent in magnitude. So it's really like economists often believe that the markets are just a random walk and you cannot predict them in any way or form. That's even true today in some of the economic literature. Yeah? And that is actually not true. Just looking at the chart of the most successful quant funds would tell everyone in 101 already that is not true. So it's the search for anomalies that are repeatedly there in the data. And then, of course, exploitable anomalies, because some anomalies are so small that you cannot reasonably trade them, simply because the execution costs, slippage, commissions would not allow you to trade them, or you could just trade them with a tiny amount of capital, and it's simply not worth it. So that's basically what quants are after. Quants are looking for anomalies in the data, and the methods how to find these anomalies are countless. So there are people from various backgrounds who are very successful in quantitative finance. This can be your regular mathematician. This can who maybe applies some time series analysis or econometric methods or something like that, or probabilistic statistical methods. This can be your aerospace engineer. This can be someone with a physics background who applies some chaos equations or something like that for chaotic systems on that. Yeah, there are people experts in natural language processing that have revolutionized the field of quantitative trading in its early days. So you can apply really all the methods that are out there in mathematics to try and detect these anomalies. But to get back to 101, so what you would probably do initially, if you're training a quant, is try to find a trend following algorithm, or try to find a mean reverting algorithm. So a trend following is nothing else but an anomaly where you have the market rises for a certain period of time and then it tends to continue going up or going down for that matter. So if you have an up day, it's more likely that you have an up day again, or something like that. Or if you have 3 up weeks in a row, it means usually you get a 75% chance to a fourth or something like that. Yeah. So those are not anomalies that you can find in the data, maybe depending on the market. And that you can try and build a system around it. And then the task is to fit it on the past, but not to overfit it. And that is really where things get tricky, because oftentimes you think you have an effect, but you were just fitting it to past data, because the more degrees of freedom you allow your system to have, the easier it is to perfectly describe the past, but the less predictive quality your system will have. So the holy grail of quantitative finance is to find a system that has a robust anomaly that is consistent over time and requires only very few parameters to describe that anomaly.
Robust and consistent over time with few parameters to describe that anomaly. And that, I imagine, is going to be like a target that many people will see. So there's also an element of, you want to have some way that you came across this insight that others wouldn't have seen it. Otherwise, it would be traded out of opportunity. Yeah,
that is also correct. So the technical indicators that used to work pretty well, so back at the turtle traders when they were inventing their RSIs and ADXs and then all of that, you can test that on historical data. It really used to work pretty well in the early years. So in the 70s, in the 80s, that was top-notch, cutting edge. We didn't have computers, or not every trader had a computer back then. So you really had an edge with those methods. But over time, the more people have access to these methods, the less of an effect it actually is in the markets. That doesn't mean that the tool, the RSI as a tool, is obsolete. You just need to find your own way to model the RSI in a way that it actually describes an inefficiency.
And in chess, I believe this is still true, is that the best chess algorithm combined with one of the world's best chess players is better than another chess algorithm. I don't know if that's still true, actually, but at one point that was true. Eventually that would just, human brains would become irrelevant and the algorithms would be so good. But with that, we, at least at the moment, we provide some marginal benefit. Is that the case with trading? I mean, do you feel like the ideal algorithm, it encompasses a sophisticated mathematical basis, but it has a partnership with a human to interpret the non-quantifiable world situation? Or do you think we're just dragged on the system?
I think we're not there yet that computers invent quantitative trading algorithms and make humans obsolete. This is tried often with machine learning or other artificial intelligence methods. There is no, to my knowledge at least, no super quantitative hedge fund that has mastered this technique and now dominates the markets, and everyone else has not a chance anymore. So humans are still very good at coming up with these effects and building models around them, finding patterns that machines would not yet think of, if you will. So to put it simply, which is also the reason why all the most successful quantitative hedge funds have all hundreds of physicists or mathematicians working for them. So they are not yet obsolete, and I believe in the foreseeable futures they also won't be obsolete, because ultimately what drives the market is the sum of all market participants' decisions, and many of them are still based on human emotions after all, because humans have greed and humans panic, and those are simply patterns that you will have in the markets for as long as humans trade.
Maybe it's a limitation of the data input. Like if you think of human brains as computers, we're not perfect computers. One thing we do better than computers is we can interpret non-quantifiable data that's not in bits and zeros or ones and zeros on we can translate that into some measurable, action. Like I watch Elon Musk get on stage and it's like, he's really passionate. Everyone's cheering. These employees clearly have high morale. And I know that morale means people work harder, more productive. And I think that the stock is going to go up. Like, unless I don't see how, given that piece of information, say like a conference or something, you can interpret, because if we're ultimately what we're measuring is humans' value on these items. Like, we're saying, how much is the Tesla stock going to go up? Well, the fact that it goes up is determined by the company's, unless all companies are all machines and no one is employed, there's always going to be the human element to the likelihood of success or trajectory in a given company. That's where I feel like, oh boy, is it possible that quantitative trading becomes the majority, or is that just a gap in the quantitative market surface area for the foreseeable future? I don't know.
I think the percentage of quantitative finance or quantitative trading on the markets will constantly increase, but that also doesn't mean that people become obsolete because someone has to build these machines or these quantitative trading algorithms. And it is also a big misconception to believe that once you've built a quantitative trading algorithm, it will run forever and just be a money printing machine. That's not true. You might have been the first one or one of the first ones who discovered an anomaly, but hundreds or even thousands of smart quants worldwide are trying to find exactly the same thing that you find, and maybe they describe it a little differently. But in 3 to 4 years, that effect is probably gone, and you're back at square one, and you have to invent a new system. So someone needs to build the efficient machines that trade the markets, and that in the foreseeable future, to me, is still going to be a human. But you're also right that things are worth what the value that people attribute to them, and that's more true than it is in crypto. Also there, the entire network effects, the entire cryptocurrency industry, every crypto out there has exactly the value that people attribute to it. And every crypto out there lives off its network effect. So the more people attribute the value to it, the more valuable it becomes. That's Metcalfe's law, and that is very true in crypto as well. But it also applies to traditional markets. And Tesla is a very good example in traditional markets. Or also Apple, where there is really a cult behind the brand, and people are actually super excited about that brand and about the CEO of that brand and the innovation that they do and their products. But the same is true for crypto, and that's for Bitcoin very true, and also for Ethereum and for a couple of other big projects as well, or good projects.
It's almost like there's a spectrum here where you have like practical value determining the value of something. So take a car, for instance. A car has a very measurable impact on my life. Like, I can calculate the time it would take for me to take public transit or the cost to take an Uber. And so I can pretty squarely place a value in it and in my life. And things that I feel are very commoditized are very efficiently priced into people's individual lives. On the other side of the spectrum, if you take this the other way, this is where I feel NFTs live today, is if I create a piece of art, and art generally speaking, but particularly NFTs because they allow pricing and indexing and algorithmic trading. So if you think about that, there's no intrinsic value that a piece of art provides to my life. It's not to say it doesn't provide value, but the value it provides to me may be way different than to you. So it's an interpersonal. It's like whatever my psychology needs from this piece, it's valuable to me. Do you feel that there's like algorithms flourish on one end of the spectrum versus the other? Certainly they have traditionally have access to data on the more commoditized markets, but now that NFTs are allowing free trade of more, I don't know if you'd call it superficial or subjective assessment of value. It's almost like the algorithms are going to be reverse engineering the human mind and psychology, where it's like trying to determine what things are worth. I don't know if you thought about that at all.
Yeah, and I think they are really bad at it. So I wouldn't want to trade NFTs algorithmically because you don't have data. to build your algorithm with in the first place. And then it is super hard to predict what humans value. And it's also very discretionary. So why is one CryptoPunk worth more than the other? Yeah, you don't know that. And why CryptoPunks and why Board Monkey Yacht Club and not something else? Yeah, so this is really something where a machine would always have difficulty to struggle or would struggle with. Yeah, difficulty to predict. Out of all the NFT projects out there, why do exactly these two make it? Yeah. And then of course, you could look at something like, okay, how much traction does it get? How big does the network get early on? How early on is the project compared to others? So how much competition is there in the space and things like that? But it's virtually impossible to train an algorithm because an algorithm needs to have seen that already in order to be able to predict it the next time. Yeah. And if it's a first, then it's almost impossible to predict. So with something that is super subjective, like art or collectibles, a baseball card or something like that, super hard for computers, and something that has a lot of data and basically operates forever in the same under the same set of rules, under the same patterns. Yes, you can use that for quantitative trading. So stocks, commodities, those types of markets. So you can use those. But
would you say that humans have an advantage over computers in trading art and items that don't have, what would you call it, practical real world implementation value? Where, you know, this Bored Ape is it's not, why does a computer trip up there, or mathematical model, for lack of data? And then will humans always have an advantage in trading these things? Because people buy, I would say the vast majority of people buying NFTs today and are doing so to make money, so they're placing bets.
Yeah. I wouldn't want to say that humans will have an edge over computers in any discipline forever. But in the foreseeable future, I don't see a computer replacing a successful human NFT trader, for that matter. So yes, I think in the next decade or two, we will probably not see a computer overtaking a human NFT trader, simply because it is so subjective what we humans value. And I don't see a computer getting anywhere close to predicting that accurately.
Yeah. One thing I wanted to ask you is you talked about earlier on, and you frequently point to the value of people everywhere across the world having access to all markets, 24/7 liquidity without middlemen. What countries or groups of people benefit the most? Whose lives raise up quickest and the most from having access to that?
Yeah, I think many people in emerging markets, just think of South America, Latin America, even Africa, of course, and also some parts of Asia will benefit from that greatly. That they now have a permissionless platform that empowers them to, at least virtually, trade, and that's our goal, pretty much any asset in the world, with a portfolio that can be as little as $1 or $2, or can be as big as 1 million, and you can trade 24/7 without having to pay fees. You can short every market, and you get access to every market on the planet, essentially on one single platform. So I believe that these people in emerging markets benefit the most. With that being said, I also think that we have a very attractive offer for people in Europe or in the US, simply because we can offer trading and investing as it should be. And you've mentioned already initially, so yes, you should want to have access to all the markets. You want to be able to short them. You want to be able to trade them with perfect liquidity, so no constraints on that. You don't want to pay fees. You don't want to have slippage. You want to be able to leverage it. And you don't want to have to ask for permission to trade a market, or for that matter, needing someone else selling you a stock when you want to buy it. So what we're building is really the challenger broker of the challenger brokers, the unbroker, if you will. We're building a platform that offers trading and investing as it should be in an ideal world.
I think that's brilliant. When say one thing I'm curious about is the proportional size of the secondhand betting market that you're creating versus the actual exchange that determines, say, pricing? Because the, say, Apple price, for simplicity, it's pushed up and it's pushed down, and it finds its price through that supply and demand equilibrium. Changes all the time based on how much demand or supply there is. I should say, yeah, supply being the desire to sell versus the desire to buy. If those traders were to move to the secondhand market, say, just for simplicity's sake, say half the traders that are trading stocks today move to your exchange at Morpher, and they're trading secondhand, does the impact of pricing become more volatile, where when you have less people trading on the first-hand markets, I mean, eventually if you move down to like 1% of people trading on the stock, how does this, have you thought about that, or the impacts of that potentially happening?
Yeah, so spot markets don't go away, and derivative markets can always be orders of magnitude bigger than the spot markets.
Okay.
You see the same with commodities, essentially. So with oil or gold, those are super important markets for the global economy, oil, for example. And yet the most trading volume happens actually on the derivatives markets, so on the futures markets, because they're easier accessible, they're easier tradable. So very, very little people actually ask for delivery of the crude oil contracts that they trade. So actually, it's maybe 95% of all people just are interested in the price of oil and are just trading futures, and maybe 5%, and that's a very high estimate now. Maybe 5% actually are looking to get physical delivery of the underlying commodity. So derivatives markets can be orders of magnitude bigger than the underlying spot markets and work perfectly fine. And we are one level even above derivatives. We are virtual derivatives with Morpher. So there is no feedback loop to the underlying market whatsoever. Yeah, already, as you've mentioned, if everyone wins on Morpher, if winning should be super easy, then you have to be still better than the other traders. And if winning on Morpher is hard, it's easier for you individually to win. So you have to beat the inflation rate on Morpher, but you also have to do that as a regular trader. You can make 10% on the stock market, but if inflation is 7%, you have actually just made 3%, even if you have now 10% more dollars than in the year before. So inflation rate is something that exists in traditional markets. It exists on Morpher, and derivatives markets can always be orders of magnitude bigger than the underlying spot markets and still work perfectly fine.
This might be a dumb question, but how does the derivative market affect, if it does at all, the spot market? And the spot markets are, when you say spot market, that's just referring to the actual people trading goods and services and the pricing of that. So oil from people from like an airline company who wants to receive oil. What happens? Is there a feedback loop? Like, does the spot market get influenced by the derivative market, or is it, or not?
Yes, definitely. So on traditional two-sided exchanges, and let's take maybe the oil market again, the spot market and the derivative markets influence each other very much. So there are some traders that do just carry trades. So they purchase something right now and sell it at the same time 3 months in the future, and just keep it in the meantime and pocket the difference and so on. So yes, derivatives markets and spot markets are highly correlated on two-sided marketplaces. That is something that won't be true in that sense for Morpher. So we are completely decoupled from the underlying markets. And this is both a risk, but it is also a huge opportunity, because if we see that that traders make use of this systematically on our platform, we can actually turn their collective predictions into a well-performing fund product and consistently beat the markets then. Yeah? So if there should ever be a feedback loop between traditional markets and our platform, then we can use that feedback loop to, again, trade the spot prices ourselves, to eliminate the feedback loop on the one side and to profit from it on the other side. So that's, to us, more a business opportunity than something that we're afraid of happening.
It's interesting. Yeah, it's fascinating. The feedback loops between derivatives and spot markets. Last question for you on price with the MPH, I think it is Morpher token. Is that what it is? Yeah. Do you think of this as an investment that people would consider? I mean, if they think, hey, if Morpher is going to be successful, I'm not going to be doing day trading, but I believe in Martin. I think the team's great. Do you look at this as a vehicle for investment that the token, if the project is successful, should increase in value?
Yeah, so by design, the token will increase in value if the project is successful, simply because there is a finite number of token, and the more people are using the Morpher network, the Morpher protocol, the more demand for the token will be there, and the higher the price. Because if a finite supply meets rising demand, prices go up naturally. Of course, the opposite is also true. So should we not build a product that people appreciate or not grow fast enough or anything like that? Or if the crypto markets are entering crypto winter, as it appears to be now the case, then of course the price of our token will also go down with it. So I'm not saying that it is guaranteed that that our token goes up. I definitely can recommend for people who want to have the perfect trading experience to buy the token, because they need the token in order to trade on Morpher with 0 fees and infinite liquidity. And beyond that, of course, yeah, if someone is interested in participating in our project, then of course they are invited to buy the token. But I cannot make any guarantees, of course, as to the value of the token, because it's more a currency in our case. Yeah, you can think of it as the settlement currency of our protocol. So if you making benefiting off of Morpher is to a large part dependent on you, because you can use the token to make a bet on Morpher, and that bet can either be successful or unsuccessful. And yes, there is the additional risk that the token might go up or down in between, but you are really in charge of your own fate, so to say. Yeah, and you can use the token to much greater effect if you don't rely on just prices will probably go up with the token versus I invest the token and I do something with it actively.
Well, I should mention you guys have raised some money. You've raised, I believe, 8 million, 9 million, somewhere in that range.
Yeah, 8.5. Yeah.
Growing. Are you guys a remote team? Are you only located in Europe?
Yeah, at the moment we are almost entirely all in the same office. So we have 2 remote employees. We're still very early on, so
Nice.
early stage. We're 12 people at this point. We're working based out of Vienna, out of Austria. So my co-founder and I moved to Austria when we started the company, pretty much right after incorporation. We have raised 8.5 million so far from Tim Draper's fund as our biggest supporter and backer, but also from the Austrian deep tech fund Apex Ventures and RTP Ventures. An international venture investor from the UK and Canada and then Russia. So interesting backgrounds. And yeah, we are building Morpher based out of Europe with an almost exclusive on-site team. So we're pretty old school. Yeah.
Nice, man.
But we're open, of course, to remote as well.
And are you writing publicly online anywhere? Do you have a Twitter or a blog or anything that you are available on?
Yeah, we have both. So we have a company blog, and we do also have a company Twitter. So the Twitter handle is Morpher_IO. That's our Twitter handle, and we also have a Discord community. And you can find links to all of this on our website. That's on morpher.com.
How about you?
Morpher comes from morphing, so changing into a market. Yeah, I also have a personal Twitter, but to be honest, I don't really use it a lot. Yeah, I rather use the company channels for my communication.
Sure. Sorry, I interrupted you there. Morpher comes from the morphous to change. Is the etymology of that?
Yeah, the idea is you can morph the token into any asset of the world. So into any other asset. Morpher token can become any other asset, and thus you morph it. You just change its shape into what you want it to be.
I dig it, man. I love this project. It's actually a lot simpler structured, a lot simpler conceptually than it comes off as. Like it's a betting market that has its own independence currency. And it's like that makes a lot of sense. You're not integrating into exchanges or placing trades or anything like that. So I love it. I can't wait to see you launch in the US selfishly, and keep kicking ass, man. Congrats on all the success so far.
Yeah, awesome. Thanks so much, and thanks for having me.
See you, Martin. Bye.
Bye.